Wouter, how have the global markets been performing this year?
I think it's been a tale of two halves. First quarter, maybe even the first half of the year, we've seen quite decent performance. The market was up mid to high single digit levels, but then in recent weeks, recent months, we've started to see some nervousness in the market. There's a lot going on. People are worrying about Europe flirting with a new recession. People are worried about geopolitical risks being back on the table with Russia, with the Islamic States, with even Ebola outbreaks now spreading through the rest of the world. And I think most importantly, people are worried about upcoming interest rate hikes in the UK, in the US, and how that might impact the global economy and stock markets. So that's the negatives. The positives are that we're worrying about these interest rate hikes because the economies are doing better in the US and in the UK. We're seeing better job growth, we're seeing better GDP growth, we're seeing more loan growth, so a lot of growth. And that is the reason why interest rates might go higher. Also, the US and the UK are leading economies. They're far more important than the European economy. And so even if Europe would have a little bit of a recession, if the rest of the world is doing better, I'm sure they could pull Europe out. And then lastly, as a positive, there's more quantitative easing these days, more in Japan, more in Europe. So it's a mixed bag, but it's creating some nervousness, and I think it's more a sentiment thing than a fundamental thing. We've just had a very strong market. We're coming up to a record amount of months of the market continuously going up, and it's just time for a bit of correction and for steam to get out of the market.
So how has Henderson Global Trust been performing in this environment?
I think we've done quite well. Up until the end of September, we were up 6.8% year to date. I think the most important metric that we can look at is peer group performance. And if I look at the global trusts on a 3-year horizon, for example, we will 49th out of 53. 53 being a peer group of 53 global funds that we look at and that the board of the Henderson Global Trust looks at. It's not exactly stellar performance. Somewhat better on a 1-year horizon, but still 37th, not that great. But then when we look year to date, since there's been a change in fund manager, performance has moved up to being 15th out of the peer group. So I think we're seeing a strong improvement in performance.
Have you made any significant purchases or disposals in the trust?
Turnover has been fairly limited. This year we've done less than 20%, despite this being a transition. But we've bought some pretty big new stocks and we've sold some others. If I have to highlight some, I think I'd highlight CTT, which is a Portuguese postal office. We've added Dollar General, which is a low-end retailer in the US. And we've started to add Rexel, which is a French home building distributor. If I look at 3 key sales over the past few months, I'd say Legrand, which is the company that manufactures the products that are distributed by Rexel, but Legrand was trading at double the price as Rexel, so we've sold that one. We've sold Walgreens, which is another US retailer, but again substantially more expensive than Dollar General. And we've sold BBA Aviation here in the UK, which is a business jet manufacturer. If I look at more broader trends within the portfolio, we've increased the US weight. We're about 10% underweight US when I took over at the start of the year. We've largely closed that underweight, and that's been a contributor to performance because not only the US market has been quite strong this year, but also the US dollar has been one of the stronger currencies.
Finally, Wouter, you've identified a little bit of market nerves at the moment. What's your outlook for markets in the coming period?
The easy question. Look, it can go two ways. Either the market just comes out of this pause and continues to go up. If that's the case, then the stocks that have gone down the most should be the ones that recover more quickly. The other alternative would be that we get a more broader market sell-off. We started to have a bit of a sell-off in the market, but it was mainly concentrated towards smaller cap stocks, small cap, mid cap stocks, whereas some of the large cap stocks have continued to hold up. And because a benchmark is market cap weighted, the benchmark itself has corrected, but not as much as a lot of its underlying stocks. So the second scenario would be a more broad sell-off and large cap starting to underperform. And that would be my key scenario, and I think we're seeing that now a bit in recent days and recent weeks. But I think it won't be that much, or it won't be a very heavy sell-off. If I put it in perspective, I'd say on average throughout the past 100 years, when we get a market recession, the stock market sells off about 25%. Given everything I've said, Europe is flirting with a recession, but the rest of the world isn't really. And so I expect the correction to be less than that. To get a really bad scenario and have a 50% sell-off like we saw in 2008 or 2001, we need something far more drastic, like 9/11, like Lehman Brothers going bankrupt. I think nothing like that is on the horizon. So I think we're looking at a smaller correction, sentiment to normalize a bit, steam to get out of the market, and then as we get closer to year end or we go into next year, I think we can start looking at an upward market again.
Wouter, thank you.
You're welcome.